Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 16th, just after the close. Let's take a quick minute to just review markets this week, and then I want to spend a couple of minutes describing some of the trades that went on within our portfolios this week. Try to be transparent, give you a thought and idea of what you're seeing for clients in your portfolios, and for friends, just what our thinking is in terms of the markets today. So, good bid throughout the week. Broad indexes up 1.5% to 2%. EFA overseas strong. Even emerging markets got back into the act after about 4 or 5 weeks of subpar performance. So on the surface, markets steady drumbeat, forward, higher. We did have some changes in our U.S. portfolios. And let's take a step back here. We run a U.S. ETF portfolio that also is used in our U.S. balanced portfolio and our global equity portfolio. So when we have a change in our U.S. ETF portfolio, it has subsequent changes in multiple portfolios. As I've mentioned in the past, a portion of the U.S. portfolio is managed in a quantitative style. Dr. Chen, Leo Chen, manages that effort here at Cumberland. Leo's a mathematician. He is a professor at the University of South Florida, and we have found his work very helpful. He's, of course, an employee of Cumberland as well. So this week, Leo reached a target on his quant work, which gave us an exit signal on a trade. Back on in the first week of March, we got a buy signal. In Leo's trading strategy, we went 100% along the S&P. We have reached a target. In the trading schedule, we go to cash. We go to 0% equity. That's in the trading strategy. In the U.S. ETF strategy, 10% of the portfolio is managed with that quant approach. So the S&P 500 was sold today in our U.S. ETF strategy. There's a second component to that. When we reach a target and go to cash, another 10% of the portfolio switches from high beta to low beta. What is beta? Beta is the measure of volatility of a security or index or portfolio versus the market as a whole. So when we're on a buy signal and expecting the market to rise, we want a little extra volatility. It would make sense that if extra volatility is being used in a rising market, we can garner some outperformance. So we had consumer discretionary, which was a recent add, energy and tech in the U.S. ETF portfolio as high beta or high volatility plays. Bang! We hit our target today. S&P 500 goes to cash. The next 10%, which was energy, tech, and discretionary, are sold, and 3 low beta sectors come into the portfolio. Consumer staples, utilities, and telecommunications. Those are low beta sectors which will try to cushion or dampen any drawdown we have from this level. We don't know if there'll be a drawdown, but when our quant work hits a level that we start to pick up higher degrees of greed in the market, we want to get a little bit defensive. So by employing cash with 10% of the portfolio and low beta with another 10% of the portfolio, we try to dampen the drawdown. Remember, this is theoretical. We've been using this in the portfolios for a couple of years, and we like the additional performance that it adds to the portfolio. Where we really like it is in dampening the downside. So in theory, we're getting a little bit defensive in our U.S. portfolio, which carries over to our global equity, which is U.S. and international, and carries over to U.S. balanced. So I hope I didn't get too involved, too down the rabbit hole here, and maybe next week I can bring out a chart that describes this a little bit easier. We were just too busy for me to get that chart up today. But clients, you'll see some activity in your portfolios. If you have any questions, as you know, reach out, email me directly. We always respond. Have a great weekend. We'll speak next week.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors. It is Friday, April 16th in the late afternoon. I'm filling in today for John Musso, who's actually traveled to the East Coast of Florida to meet directly with clients. So yes, we are having a return to normalcy. People at Cumberland are coming back into the office slowly but surely, or some at home, some in the office. Many are vaccinated, and we are meeting with clients that are comfortable with meeting as long as us being comfortable. So that's a good return to normalcy. So with the bond markets this week, the Treasury market rallied a bit. The 10-year went down to 158, down about 8 basis points from last week, and the 30-year yield declined about 6 basis points to a 227. Housing starts, retail sales, the stock market, the fact that 200 million of us have been vaccinated, all bode well as initial jobless claims that we look at all the time were much better than expected at 576,000 compared to the expectations of being down 700,000. And it may have been an overreaction to the not as such good number that we had last week, where the jobless claims increased more than was anticipated. And CPI was a bit benign. The Fed has also continued to say that it will be accommodative. They're waiting to see how the economy really does evolve, not getting too far ahead of themselves. So while that was good for the markets this week, Muni yields also rallied. The 10-year was actually up 10 basis points, yielding only now 0.93% in the 10-year space. And the 30-year is now yielding 155, having rallied. Yield had gone down about 9 basis points. Muni demand has continued to be strong. People are feeling more comfortable with municipal credit quality, and the specter of higher taxes makes munis more valuable. But the ratios, the Muni Treasury rates are going down. So now the 10-year ratio is at 59% and the 30-year ratio is at 68%. And next week, we have a lot of Muni supply coming down the pike. The forward calendar is about 11 billion. Only 2 billion of this is taxable Munis. So that's 9 billion of tax-exempt Munis for the market to eat up. Also, with the extreme demand for Munis, the fund inflows into high-yield mutual funds was at a record 1.28 billion, showing that people are still reaching for yield and are comfortable with credit quality. Now, we do expect blips over time from supply and demand, or from outflows, possibly from mutual funds, which tend to turn on a dime, and it could come from a credit issue, or it could come from a technical issue, but we would see that as a buying opportunity because we are pretty constructive on municipal credit quality. Lots of working parts, lots of things to be adjusted for. So some Republicans are pushing for a scaled down plan for just roads and bridges. Get a little bit of it going at a time. Don't know if this is possible. We've seen before where it really is a bipartisan issue to take care of our nation's infrastructure, which does need improvement. It would help our economy move smoother. Thank you very much, and we'll talk to you again next week.